I. This is the fourth complete comprehensive example. In this example sum, we will deal with the situation where the premium for goodwill is not brought in by the incoming partner. So let's go to the example sum. Example sum. A and B are partners in a firm. Their balance sheet as at 31st March 2019 was, to the left of the screen we have the balance sheet which is given. On the right, additional information. On 1st April 2019, they admitted C as a new partner on the following conditions. First point, C brings in rupees 40,000 as his share of capital, but he is unable to bring in any amount for goodwill. Point 2, the new profit sharing ratio between A, B and C will be 3:2:1. Point 3, claim towards workman compensation is rupees 3,000. Point 4, bad debts amounting to rupees 6,000 are to be written off. Point 5, creditors are to be paid rupees 2,000 more. Point 6, rupees 2,000 be provided for an unrecorded liability for damages. Point 7, outstanding expenses be brought down to rupees 1,200. Point 8, Shika, an old customer whose account was written off as bad debts, has promised to pay rupees 2,500 in settlement of her dues. Last point, goodwill is valued at 1.5 years purchase of the average profits of the last 3 years less rupees 12,000. The profits of the last 3 years amounted to rupees 10,000, rupees 20,000 and rupees 30,000 respectively. We are asked to prepare the revaluation account, the capital accounts of the partners and the opening balance sheet. Now, in the first point over here, it says C brings in rupees 40,000 as his share of capital, but he is unable to bring in any amount for goodwill. So this tells us that the sum is based on the situation where the incoming partner is unable to bring in his share of premium for goodwill in cash. So we'll have to pass the entry by debiting C's current account with his share of goodwill. So we'll go to the solution. We'll begin with the revaluation account, prepare the partner's capital account after that, and then the balance sheet. Solution. Revaluation account. Left side debit side, right side credit side, particulars, rupees, particulars, rupees. The first point about the capital and the premium for goodwill will not affect the revaluation account. Second point, the new profit sharing ratio between A, B and C is given. That also will not affect the revaluation account. Third point, it's given that claim towards workman compensation is rupees 3,000. The reserve which is appearing in the liability side of the balance sheet, the workman compensation reserve, it's appearing as rupees 5,600. The claim is only 3,000. So the balance 2,600 will be distributed among the old partners A and B in their old profit sharing ratio. So this third point will not affect the revaluation account also. The fourth point says bad debts amounting to rupees 6,000 are to be written off. Now if we see here in the asset side of the balance sheet, we have a provision for bad and doubtful debts already created to the extent of rupees 4,000. I'll pass the entries, journal entries in the working notes, and we will see how to treat the fourth point. The first entry is for writing off the bad debts of rupees 6,000. Bad debts account debit 6,000 rupees to sundry debtors account 6,000 rupees. This is for bad debts written off. Now we need to provide for the rupees 6,000. In the balance sheet we have provided already only for rupees 4,000. We will utilize the 4,000 and debit revaluation account with the other 2,000 rupees. So it's provision for doubtful debts account debit, ₹4,000, revaluation account debit, the remaining 2,000 to bad debts account. The 6,000 rupees which was written off, being bad debts provided for. So in these two journal entries, we need to get the part which will affect the revaluation account. It is revaluation account debit to bad debts account rupees 2,000. So let's enter that. To bad debts account 2,000 rupees. The fifth point, creditors are to be paid rupees 2,000 more, increase in liability. So to creditors account 2,000 rupees. The sixth point, rupees 2,000 be provided for unrecorded liability for damages. We need to provide for an unrecorded liability. So to liability for damages account 2,000 rupees. The seventh point, outstanding expenses is to be brought down to rupees 1,200. The word to means from the figure of 3,000 rupees, we need to bring it down to 1,200 rupees. So we are reducing the outstanding expenses by 1,800 rupees, which is rupees 3,000 minus 1,200. So reduction in liability by outstanding expense account 1,800 rupees. The eighth point says, Shika, an old customer whose account was written off as bad debts, has promised to pay rupees 2,500 in settlement of her dues. The word promised indicates that it is not a actual transaction. An intent or promise to do something will not amount to a transaction, and therefore we will ignore this eighth point in the entire sum. Ninth point is about goodwill valuation. This will not affect the revaluation account. So we've completed the revaluation account. Let's balance it. Greater total, debit side 6,000. We are left with a loss on revaluation account by loss on revaluation transferred to partners capital accounts. We have A and B. Total loss 6,000 rupees minus 1,800 rupees, which comes up to 4,200. The profit sharing ratio is not given, so we assume that OPSR is equal. So between A and B, it will be 1:1. So A gets 1/2 of 4,200, which is 2,100, and B also gets rupees 2,100. So this is a revaluation account which is prepared by us. We are left with a loss which was divided equally between A and B. Next, let's go ahead to prepare the partners' capital accounts. Partners' capital accounts. Left side debit, right side credit. Particulars: A partner, partner B, and partner C. Particulars: partner A, partner B, and partner C. We'll begin by bringing down the balance of the capital accounts by balance brought down. 50,000 for A and rupees 60,000 for B. Next item, C brings in rupees 40,000 as a share of capital. So by cash account, capital brought in by C is rupees 40,000. We'll transfer the loss on revaluation to revaluation account. The loss was 2,100 for A and 2,100 for B also. Next, we'll deal with the reserves. The claim towards workman compensation, it's given in the sum as rupees 3,000. There's a reserve of 5,600. So the excess of 2,600 to be distributed amongst the partners A and B in 1:1. So by workman compensation reserve account, 2,600 rupees in 1:1 comes up to 1,300 for A and 1,300 for B. There are no other reserves. There is an accumulated loss appearing on the asset side of the balance sheet, which has to be written off among the old partners in old profit sharing ratio. So to profit and loss account, 4,000 in 1:1, 2,000 for A and 2,000 for B. Let's deal with goodwill. We need to calculate the goodwill of the firm as per the 9th point. Goodwill is to be valued at 1.5 years purchase of the average profits of the last 3 years less 12,000. And the last 3 years profits is given as 10,000, 20,000 and 30,000. So let's go ahead to the working notes to prepare to find out the goodwill of the firm. We have the working note 2, calculation of goodwill of firm. Average profits is equal to 10,000 rupees plus 20,000 rupees plus 30,000 rupees divided by 3 years, which comes up to rupees 20,000. So goodwill of the firm is equal to 1.5 years purchase multiplied by 20,000, and from this we need to subtract rupees 12,000. So in other words, it's rupees 30,000 minus 12,000, which is equal to rupees 18,000 is the goodwill of the firm. Next we'll find out C share of goodwill. ₹18,000 into C share in profits 1 divided by 6, so it comes up to rupees 3,000. Now we need to see what the sacrificing ratio is. So working note 3, calculation of gain or sacrifice of each partner. We have the OPSR given between A and B as 1:1, and the new profit sharing ratio between A, B and C as 3:2:1. So for partner A, old share by 2 minus the new share 3 divided by 6, it's equal to nil. No sacrifice or gain by A. As for B, we have old share 1 by 2 minus the new share 2 divided by 6, which is equal to positive 1 by 6, and B sacrifices. So the entire amount of rupees 3,000 has to be credited to B's capital account. So the journal entry will be C's current account debit, working note 4, journal entry for goodwill. C's current account debit to B's capital account. 3,000 rupees, which is C share of goodwill, fully credited to the sacrificing partner B. So let's enter this in the partner's capital account. So we have by C's current account 3,000 rupees against B. So we've completed the items in the partner's capital account. Let's balance the account. Total of A 51,300. To balance carried down, we need to deduct 4,100. So we get 47,200. The total for B is 64,300. We need to deduct 4,100, so we are left with 60,200. C's total 40,000, and the balance carried down is also rupees 40,000. So this is a capital accounts which has been prepared by us. Capital balance of A 47,200 rupees, that of B 60,200 rupees, and that of C 40,000 rupees. Let's go ahead to prepare the balance sheet. Balance sheet as at 1st April 2019. Left side is the liability side. Rupees. Right side, asset side. Rupees. We'll begin with the liability side items. The workman compensation reserve has been replaced by the claim. So we have workman compensation claim, and the amount of claim is rupees 3,000. Outstanding expenses. We brought down the outstanding expenses to rupees 1,200. Next item, creditors. As per the 5th point, creditors are to be paid rupees 2,000 more. So now it's 32,000. There's a 5th point where we have provided for an unrecorded liability. So liability for damages 2,000 rupees. Let's insert the capital balances of the partners. Capital accounts. We have A, B, and C. Let's check out the capital balances from the partners' capital account. So 47,200, 60,200, and 40,000. 47,200, 60,200, and 40,000 rupees. The total ₹1,47,400. Let's continue with the asset side items. Cash. The opening balance was rupees 10,000, and the capital which was brought in by partner C was rupees 40,000. So final amount for cash rupees 50,000. Sundry debtors. The figure of debtors 80,000. We need to write off bad debts of rupees 6,000. Less bad debts 6,000 rupees. Final figure 74,000 rupees. Stock. There is no change in the value of stock. It's 20,000 rupees itself. Machinery. There is no change in the value of machinery also. So it's 38,600. The profit and loss account has been written off among the old partners in old ratio. So that also will not appear in the reconstituted balance sheet. The last item, C's current account. The account opened by us because C was unable to bring in his share of goodwill of rupees 3,000. So that's 3,000 rupees. I'll remove the split and then we can see if the balance sheet is tallying. The total of the liability side is 1,85,600. and the total of the asset side is also 1,85,600. So we'll see the entire sum. So this was the revaluation account where we got a loss of 4,200 rupees. Then we went ahead to prepare the partner's capital accounts. The capital balances of partner A, 47,200 rupees, that of B, rupees 60,200, and that of C, rupees 40,000. And finally, the balance sheet. This is a balance sheet that has been prepared by us, both sides tallying with 1,85,600 rupees. And finally, the working notes. This was the first working note for the treatment of bad debts and provision for doubtful debts. The second working note was to calculate the firm's goodwill. The third working note was to calculate the gain and sacrifice of each partner. And the final working note was to pass the journal entry for treatment of goodwill.